Welcome to The Explainer. Today, we're going to try and crack the code of financial markets. Now, I know it seems like a really complex world, but understanding its basic architecture is absolutely crucial, especially when you're preparing for descriptive exams. We're going to build this thing from the ground up, so you can walk into any question feeling confident.
All right, so here's our game plan. We're going to kick things off with the single biggest challenge that every market faces, what we call the information problem. After that, we'll dive into the theories that try to make some sense out of all the market chaos. Then, we'll clear up the difference between creating securities and trading them, meet the key players that make the whole system tick, and we'll finish up with a look at some of the sophisticated tools the pros use.
So, first things first, the information problem. You know, at its core, finance is really all about information. But what happens when that information isn't shared equally? Well, that imbalance is pretty much the starting point for understanding almost everything about how markets are built and how they're regulated. And here it is, the heart of the problem: asymmetric information. Just think about a company going for an IPO. The managers, the insiders, they know the business inside and out. All its strengths, its weaknesses, its real prospects. Way better than you or I ever could as a retail investor, right? It's just not a level playing field. And that one simple fact drives pretty much everything, from why prices jump around so much to why we have market regulators.
And believe me, the consequences of this imbalance are huge. I mean, when some people know more than others, assets get mispriced, money doesn't flow to the best companies, it flows to the ones who are best at keeping secrets. And if regular investors start to feel like the game is rigged, what happens? They lose confidence, they take their money and go home. In a worst-case scenario, that loss of trust can actually trigger a complete market collapse.
So how do markets even begin to fight back against this? Well, they've developed this multi-layered defense system. First, they force companies to be transparent through mandatory disclosures. Second, they have really strict laws against insider trading. Third, they rely on independent third parties, think auditors or credit rating agencies, to check the facts. And fourth, they require constant monitoring to make sure everybody's playing by the same rules. It's all about trying to level that playing field.
Okay, so now that we get the information problem, let's look at how economists try to model market behavior. I mean, with all this complexity and all this chaos, how do we even start to make sense of the market's movements?
Now this right here is a classic concept for any exam, the efficient market hypothesis. It basically comes in three flavors. The weak form says you can't get rich just by looking at old price charts. Then there's the semi-strong form, which is where most real-world markets, like India's, are believed to be. This says all public information is already baked into the stock price. And finally, you have the purely theoretical strong form, which claims that even private, insider info is already in the price, making it totally impossible for anyone to have an edge. Getting this distinction is really key.
And to actually put some numbers to this, analysts use a really powerful tool called the market model. Now, the formula looks simple. Return equals alpha plus beta times the market return plus an error term. But it's so elegant. It breaks down a stock's performance into three clean parts: how it moves with the market, the manager's actual skill, and just pure random luck. Let's break those down.
See, this is how we separate skill from luck. Beta just measures how much a stock gets tossed around by the overall market. So a beta of 1.2 means if the market goes up 10%, this stock tends to go up 12%. It's the risk you can't really get rid of. Now, alpha, that's the holy grail. That's the part of the return that can't be explained by the market's movement. It's supposed to represent the manager's secret sauce, their skill. And epsilon, the error term, well, that's just all the other unpredictable noise that's unique to that one stock.
Okay, so we've covered the theories. Now let's talk about the actual venues. Every single security has a life cycle, right? It has a birthplace, and then it has a marketplace where it gets traded for the rest of its days. And this brings us to the crucial difference between primary and secondary markets.
This is such a fundamental distinction. The primary market is where new securities are born. So when a company has an IPO, it's selling brand new shares to raise fresh cash for itself to grow the business. The secondary market, think of the NSE or BSE, is where those shares get traded later on between investors. And here's the key difference you have to remember. In the secondary market, the company doesn't see a dime of that money. It's just a transaction between a buyer and a seller.
All right, let's tackle a concept that trips up a lot of people on exams: the bonus issue. This is something that happens in the primary market. A company takes its pile of saved-up profits, its reserves, and basically turns them into new shares, which it then gives away to its current shareholders for free.
Which, of course, leads us to a very, very common exam question. It's designed to see if you really get it. Does this act of giving away free shares actually raise any new money for the company? What do you think?
The answer is a big, emphatic no, and it's so important you understand why. A bonus issue doesn't bring in a single new rupee of cash. It is purely an accounting trick. You're just moving a number from the reserves column on the balance sheet over to the share capital column. The company's total equity, it stays exactly the same.
So we've got these primary and secondary markets. But what are the institutions that actually make them work? Let's meet the essential players that form the backbone of this entire financial ecosystem.
First up, the stock exchange. Now, it's more than just a place to trade. Its most important job is to be a guarantor. By taking a small deposit, called a margin, from both the buyer and the seller, the exchange guarantees that the deal will be completed. It completely eliminates the risk that the other person might back out. That guarantee is the absolute bedrock of trust in the market.
Next up, you have the depository. The easiest way to think about it is like a high-security bank, but for your shares instead of your cash. Institutions like NSDL and CDSL hold all the securities in electronic or dematerialized form. They check that every share is real, and they make transferring ownership from one person to another totally seamless and instant.
And of course, we have to talk about mutual funds. They are so critical for making the market accessible to everyone. They let small investors pool their money together to get two things they could never get on their own. One, access to a professional fund manager, and two, instant diversification across tons of different securities.
Okay, for our final section, let's graduate to the advanced toolkit. These are the instruments that the pros use to manage really complex risks and to place more sophisticated bets on where the market is headed.
This table breaks down the key derivatives perfectly. You've got forwards, which are basically private, customized deals. The big problem there? High risk that the other person won't pay up. So futures were invented to solve that. They're standardized and traded on an exchange, which guarantees the trade. But options? Options are the real game changer. They give the buyer the right, but not the obligation to make the trade. That flexibility is incredibly powerful.
So why do people use these things? Well, for two main reasons. Hedging is about playing defense. It's like buying insurance for your portfolio, to protect you if the market goes down. Speculation is the complete opposite. It's all about offense. It's about taking on risk, making a big bet on which way a price is going to move, and hoping to score a big profit.
And finally, we have the arbitrageurs. You can think of these guys as the market's efficiency police. They are constantly scanning for tiny, temporary price differences for the exact same asset on different exchanges. They'll simultaneously buy it on the cheap exchange and sell it for a fraction more on the other, making a tiny, risk-free profit. And in doing so, they force the prices back into alignment, which makes the whole market more efficient for everyone.
And that brings us right back to where we started, full circle to the information problem. If our markets are semi-strong efficient, meaning all of the public knowledge is already in the price, it leaves us with one last really crucial question to think about. What information is still out there? What crucial knowledge is still held in private hands? And as long as that exists, can the playing field ever be truly level?